Good morning. I'm Greg McKenna. It's Wednesday, the 30th September, the last day for the quarter for markets. Last day for the quarter, I guess, for everybody. And it's been an interesting last 24 hours. The carnage that we saw in Asia Pacific markets yesterday, which had the Japanese market down more than 4%, the ASX down around 3.5%, was not followed through in European and US markets overnight. Of course, Europe opened weak. But as the day went on, they recovered around half by the end of trade of early losses. The US was off its highs, and in many ways, the S&P was on a downslope all the way through the day, and managed to just get back into the black by the close of trade. But overall, traders will have been breathing a sigh of relief after the moves we saw yesterday. Glencore recovered about a third of its losses from the previous day, with a gain of 16 and a bit % last night. That was after the company came out and defended itself against the claims that it was essentially going to go bankrupt, that its equity value was going to be, go to zero and be wiped out by, the heavy debt load it's carrying. Glencore still has a lot of challenges. Global commodities are still under pressure, but for the moment, last night we did see some bottom fishers coming in. That's a company that's lost 88% of its value over the past few years, and it's halved up until yesterday, in the last month or so. So, is that a realistic reflection? It's an open question, and one that markets are going to try and figure out over the next few months, because it's not only Glencore and its heavy debt load, it's not only the troubles with Volkswagen and what it's done, although I heard on the radio on the BBC on the way down this morning to Sydney that Volkswagen may have a fix and is talking to regulators about it. That would be good news for all those car owners. I don't really care about the company itself. I care about the car owners and the angst that they'll be going through, because, while the Polo might be cheap, certainly the bigger cars here in Australia are not cheap, so there'll be plenty of people who are worried about that. So anyway, that'd be good if Volkswagen could that fix. But what we've got at the moment is we've got problems in emerging markets, problems with Glencore, worries about banks and their exposure to the level of debt that miners are carrying, and people like Glencore. And that's why we saw the Aussie ASX bank, the Big Four, down around 3.5% yesterday. So, but the wash up, I guess, today, end of quarter, no carnage in the US last night. It's their end of quarter tonight. A bounce in Rio and BHP in London last night. Crude up 1%, iron ore up. Copper was up 1 cent to 2.26 a pound. Base metals themselves are up 1%. The CRB was higher. Maybe it's time for a bounce. The ASX 200 SPY December futures are up 43 points. I'm guessing that we're going to see at least a rally of 1% today after yesterday's 3.5 or whatever it was we lost, and possibly more. The question is whether or not that is the low of, the market is an open one. I'm still 100% cash in my super. So from where I'm sitting at the moment, I'm expecting prices lower in the long run. Now you can see here with this chart that we've had a small rally. This level here, this 4965 price level, is the one to watch for a break topside again. We could see that today. Time will tell. But we'll have to wait and see how things go. I guess when I look at my charts, oil still holding in. The DAX last night just holding in. The S&P 500 trying to hold in. Wherever I look, markets are trying to hold in. So from my point of view, where my head's at the moment, is that my positioning is such that I'm 100% cash. My positioning is such that I am still trading currencies and things like that. And if you have a look at the currencies, even though the Aussie made a new low for the last couple of weeks, it got down to 69.34, which is just 5 points below 69.39. It's roughly back where it was yesterday morning. Same with dollar yen. Dollar yen was down in the low 119s yesterday when the carnage was at its worst. I still think it's going to 116.50. By definition, that makes me a bit of a bear on stocks, I guess. But what I found when I look at markets at the moment is that you really need to truncate your time frames. You've either got to trade a really big picture, like my 100% cash in my super, and just wait for the reason to buy back in, or you've got to trade a shorter time frame with small positions, because I'm finding it's much easier to get what's going to happen on the day right than what's going to happen on a 2-day or a 3-day or a 5-day time horizon. And if you use the same system, which I do, I use the same system regardless of whether it's for intraday or intra-week or intra-month or intra-year, and my system works across multiple time frames, multiple markets, then you can do that. So, my point of view, it's still a fractious time. We haven't taken out those August lows yet, so I'm not uber bearish. And another reason I'm not uber bearish is that everyone else seems to be getting uber bearish. All the headlines in the newspapers today in Australia and those sorts of things, that 50-something billion wiped off the stock market and woe is me and all that kind of stuff. That doesn't mean it can't go down long term. Otherwise, it wouldn't be 100% cash. But when we see things like, consumer confidence in the US last night was, well above, was 103 against expectations of 96. And the services index that came out from Dallas, I think, was actually strong, not weak. Tomorrow we're all going to focus on manufacturing PMIs, and they're likely to be weak, and there's likely to be a lot of woe is me. But don't forget, developed markets are services markets. They're consumer markets. If the services sector is doing okay, because people have got jobs, because they're buying their coffee, they're getting their shirts laundered, they're doing all that kind of stuff, they're employing people to do things, then overall, that part of the economy is doing well. Of course, manufacturing is a significant other, but part of the construction of GDP is that all the bits have to add, and sometimes they add to zero, sometimes they add to low numbers, but you're getting very different signals. And the services sector for me is where I want to watch. Today, lots of data out in Japan, so have an eye on that. Tonight we get some data out of Germany, unemployment in the EU, and we've got two Fed speakers, one of whom is Janet Yellen. So keep an eye on that. So keep your position sizes and your relative to market volatility. That's what I'm doing. Time frame matching as well is really important. We've got building approvals and RBA credit aggregates in Australia today at 11:30. Also at 11:30, I'll be on the radio, 2UE, and the sister stations around the country talking about Glencore and what's going on. What's happening at Glencore is symptomatic of what's happening in emerging markets at the moment, and that's where the real trouble lies, as Carl Icahn pointed out yesterday. There's some really good stuff on Business Insider today, so go and have a look. There's always good stuff on my website, gregmckenna.com.au. But that's it for me for today. It's Wednesday, the 30th of September. Have a great end to the quarter. Today's the last day of the financial year for the 3 of the 4 banks. So my expectation is that we'll have a much better day on stocks today. Have a great day. Bye for now. I'll catch you tomorrow. I'm Greg McKenna.